In today's video, I'm reviewing how much is your forgotten 401k costing you in potential savings. Hey everybody, it's Matthew Jackson from 401k Maneuver. Let's jump right in. You know, many investors who have left a 401k behind with their past employer may not think it's a big deal, but it is. And it's one that may be costing you more in retirement savings than you really think. Capitalized recently published a white paper named The True Cost of Forgotten 401k Accounts, stating as of May 2021, there's an estimated 24.3 million forgotten 401ks holding approximately $1.35 trillion in assets, with another 2.8 million left behind annually. And that leaving behind a 401k with a past employer has the potential to cost an individual almost $700,000 in foregone retirement savings over a lifetime. Yes, you heard that correctly. Almost $700,000 in savings being left behind in low return investments. Now, while your situation is unique and the potential amount you may be missing out on depends on your balance and fees, these statistics make the case for why it's not the best idea to leave behind a 401k. So let's talk about the disadvantages to leaving a 401k behind. You may be able to leave your 401k account with your previous employer, but there are several disadvantages of doing so. First, your account will remain subject to the plan rules. Next, you will continue to have limited investment options. And finally, you will have another account that you have to keep up with. And then there's also ongoing fees that you're going to be incurring. And you may not even realize your old 401k may be a high fee plan. According to the capitalized white paper, there remains huge variance in 401k plan fees. That is, there's a big gap between the highest fee 401k plans and a low fee 401k plan. There's also a big gap between high fee plans and the all-in costs of a low fee IRA, like an automated or robo IRA, which range between 0.2% and 0.4%. Another disadvantage in leaving behind a 401k is that it may result in overlapping funds that may not suit your tolerance for risk. Far too many investors believe that when they leave behind a 401k, their past employer is taking care of it for them. And this isn't true, you guys. It's your money and it's your responsibility. This belief may be costing you more retirement income than you realize. Because if you fail to regularly rebalance your 401k, you are essentially turning your investments over to chance. Failing to regularly rebalance your 401k portfolio often results in significant losses during bad markets and opens you up to more risk exposure than you initially had intended. And you may be missing out on earning more and keeping more of your retirement savings, which means you may need a part-time job to make ends meet during retirement. And who wants to do that? So check out our guide, Avoid These 4 Reversible and Costly 401k Rollover Mistakes, in the description box below. Now let's talk about 401k rollover options. You basically have 3 options when it comes to moving your old 401k. First, roll over into your new employer's 401k, providing it's allowed. Next, roll over into an IRA or Roth IRA. And then last, cash it out. There are potential advantages to rolling over your old 401k into an IRA. First, you can consolidate more than one 401k account into an IRA. With the right advisor, you virtually have unlimited investment options and more control over your account. Now, tax withholding is not required if you need a distribution. You have more control over naming or changing your beneficiaries, and that's a big deal. If the purpose of your 401k is to save money for retirement, we highly advise against cashing out an old 401k because you may disrupt your retirement by taking it out early. So don't do that. If you cash out and you are under 59 and a half, you're going to have to pay a 10% penalty on top of the taxes. The IRS generally requires an automatic withholding of 20% of your 401k for an early withdrawal for taxes. With your 401k, you got a tax break for saving the money in the first place because all the contributions are pre-tax. When you cash out of your 401k early, all that money that you put in and the gains that you made become taxable as ordinary income. Don't do that. Now, you may get some of that back on your next tax return, but between the penalty and the tax withholding, you're going to see a good chunk of your savings gone. So let's talk about the types of 401k rollovers. There's basically two types of rollovers, direct and indirect. Let's first talk about direct rollovers. When you transfer your money from one retirement account directly into another, with a direct rollover into your new employer's 401k plan or into your IRA, you never touch the money and no money is withheld for taxes. A direct rollover is what we recommend. Now let's talk about indirect rollovers. When your 401k account funds are given to you via check for deposit into a personal account with the intention of reinvesting those funds into a new retirement account within 60 days or less. You can make a rollover at any age, but there are specific rules that must be followed. Most importantly, you must generally complete the rollover within 60 days of the date the funds are paid from the distributing plan. If properly completed, indirect rollovers aren't subject to income tax. If you fail to complete the rollover or miss the 60-day deadline, all or part of your distribution may be taxed and subject to a 10% early distribution penalty unless you are age 59 and a half or another exception applies. In addition, your employer must withhold 20% of the payment for income taxes. After taxes are taken out, you will be sent the funds via paper check. This means that if you want to roll over your entire distribution, you'll need to come up with the extra 20% from your other funds, which you'll be able to recover with the withheld taxes when you file your tax return. Now here's a note. The IRS only allows for one indirect rollover per 12-month period. So let's talk about rolling over a 401k if you have company stock. You need to be careful when rolling over your 401k if it contains shares of your former employer's stock that's appreciated over time. In fact, in some cases, rolling over the stock into an IRA could be a costly mistake. Typically, 401k plan distributions are subject to ordinary income taxes. However, there is a special rule that applies when you receive a tax distribution of employer stock from your plan. This rule is referred to as the net unrealized appreciation, or NUA rule. You would only pay ordinary income tax on the cost basis of the stock. So what's that? The cost basis is the stock price at the time that it was purchased for you by the plan. Any appreciation in the stock will receive more favorable long-term capital gains tax treatment. The NUA rule does not apply if you roll over the stock into an IRA. So to take advantage of NUA rules, it has to be done as part of a full and final rollover from an employer plan. Now let's talk about making a decision to roll over your old 401k. It's important to understand all of your rollover options before you make a move, and make sure you get professional help. Each investor's situation is unique, and speaking with someone who can navigate the rollover process helps you make the best decision possible for your financial future. If you have questions about rolling over your old 401k, book a complimentary 15-minute 401k strategy session with one of our advisors today.